Hello traders, Gary Wagner here, just about 1 o'clock in Honolulu, 7 o'clock in New York. It is Tuesday, 12th day of May, 2020, and this is the daily report for gold and silver. With the exception of gold, the entire precious metals complex did trade lower on the day, and I believe that was in response to a falling equities markets. The primary topic on today's show is going to be looking at historical perspectives of what quantitative easing has done for both gold and equities, and I think you will see points in which there is a disconnect or the typical inverse correlation and a correlation in which they both move in tandem. But I'll explain that as we pull up our technical studies. But first, to the price board. Interesting action in the precious metals markets today, with gold closing higher and platinum, palladium, and silver closing lower. Now, there is a plausible explanation for that. We do have a weaker US dollar. That would provide headwinds for all of the metals. However, we had the stock market under pressure. We lost almost 3% in the S&P, 2% in the NASDAQ, and 1.9% or 457 points in the Dow Jones Industrial Average. The fact that the industrial components of platinum, palladium, and silver reacted to lower stock prices is not surprising. What is fairly surprising to me is gold trading higher on the day, because we've spoken about this on many occasions, and that is when there is Federal Reserve intervention, it's bullish for equities because money is cheap and easy to borrow, and that has the effect of inflating more dollars into the system, devaluing the currency, and that, of course, causes gold to rise. So, in the case of Fed intervention, you get equities and gold rising at the same time. That is the opposite from the traditional correlation of money is put either in risk-on stocks or safe haven assets such as gold. As I said in my opening letter, one day does not make a trend, but a trend does start in a single day. Gold futures basis the most active June contract, 1705.50, putting it up $7.50. Spot gained $6.63, 1702.40. Platinum did score a loss today, a little over 1%, 772.80. Palladium had a fractional drawdown today of $2.60, currently $18.25.50. And lastly, Bitcoin futures closed up about 1%, $95, and is just $110 shy of $9,000 per coin. Let's take a look at our technical studies. On today's show, I want to speak about the Standard & Poor's and the correlation between that and gold. Typically, they run inversely, meaning when equities are running to the upside, market participants as well as investors tend to move money from a safe haven asset group such as gold into equities and vice versa. When the market is coming down, gold tends to do better. The exception to that rule is Federal Reserve intervention. As you can see, we've got a split chart with gold futures on the top and the mini S&P on the bottom. It goes back to the beginning of the actual crisis, and that crisis, of course, began roughly in 2007. And traders, the crisis that led to an extremely defined recession, that recession was caused by a banking crisis in which many of the big boys actually went under because they had subprime loans that began to default. Now, here's what we're seeing. There's no intervention yet until the end of 2009, which means that when we look at this particular chart, at approximately this time frame, we had QE2 or quantitative easing 2. Now, we had gold and equities moving up in anticipation of Fed intervention, but here's what's unusual. We then got a tandem move of gold moving higher, moving up to these record tops at 1900. We also had U.S. equities running up to new record highs. However, there became a disconnect about the middle of 2011. We can mark this here. And what happened was Stocks continued to run higher. However, the gold market disconnected from that tandem move and went to a more traditional stance of an inverse relationship between gold and silver. The question is, why are we looking at that now? The reason is because of today's activity, in which we found that disconnect, meaning gold moved higher and equities moved lower, because up until this point, we have certainly had a very unified market in which they were both moving to higher ground. We can see this with the most current data as gold moved higher, and for the most part, equities moved higher. However, you can see that while gold is stabilizing and continuing to move to higher ground, we are now getting a pretty deep retracement that has been occurring this year in U.S. equities. As I said in my opening letter, one day does not make a trend. However, a trend has to begin on a single day, which is why I brought up this long-term historical chart that labels the various quantitative easing programs and terminations. We can easily see that the financial crisis began in 2007. QE began at the end of 2008. That had a dramatic effect, taking the market to record highs because they also added QE2. However, we saw the market retrace slightly, and then the announcement of QE3. For those that recall, QE3 was called the twist, and it wasn't, in essence, flooding the money supply in and creating more liquidity. Rather, they were buying a certain yield bond, a 30-year, and then selling the 10-year. And so what we saw from that was the market came down dramatically, and you can see right at this point, mid-2013, they began to taper the QE program. The market continued to go lower, and of course the announcement that the Fed had accumulated $4.5 trillion on their balance sheet, and they effectively ended quantitative easing. That takes us up to current pricing, because right now we have something that I have never heard the Federal Reserve say, and that is that they are going to re-implement quantitative easing, but to infinity. In other words, they have no guidelines, they have no parameters in which they will stop. We are in uncharted territory, and therefore the Fed is leaving everything on the table. And the reason I bring that up is I believe that the fact that they are doing such a large progressive program, the budget asset sheet with the Fed is now $6 trillion, and the amount that the Treasury Department borrowed for aid packages really amounts to another set of $1 trillion. So we are looking right now at $6 trillion being expended over this last, say, 3 to 4 months. What will that do to the dollar? And if the dollar does in fact begin to decline, where should we see gold go to? And my prediction right now maintains that we will see a challenge of this recent high right here at 1800. And I also believe that over the next year and a half to 2 years, we will certainly challenge the record top at $1,920. This has been Gary Wagner, wishing you as always good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.